Hi, guys. This is the Work Your Money podcast with host Michelle Wong. Today, I am flying solo. My co-host Willie Morales and Marcus Renton is not here today, so that means that I'm going to have more fun for myself. Today, I have a great guest, and his name is Abhi Golhar. He is the host of Estate Deal Talk, and he's also the managing partner of Summit and Crowne, a real estate investment company based out in Georgia. Hi, Abhi. How are you?
I'm great, Michelle. How are you?
I am doing awesome. So, you were just telling me about Georgia and the weather there. Just to let our listeners know.
Yeah, it is gorgeous here. You know, I think over the Memorial Weekend it was a little rainy, it was a little cloudy, but today is just beautiful. It's just right. It's just a good summer day.
Awesome. So, Abhi, just tell us a little bit about yourself. You sound so intriguing, and I just wanted to let you share a little bit about your background.
Yeah, you got it. First, thanks for having me on the show. I appreciate it. It's a lot of fun. I know we're going to have a lot of fun. My name's Abhi Golhar, as you eloquently pronounced and enunciated properly. Thank you for that. The host of Real Estate Deal Talk at the Daily Radio Show and a podcast, and I'm also the managing partner of Summit and Crowne. My background is I graduated with an engineering degree, but I never used it. I've been a real estate investor pretty much post or during college and then post college, and we do a lot of single family, new construction, renovation, development, and also multifamily acquisition in Atlanta. We're primarily based in Atlanta. We're starting to expand out a little bit into different markets. We've looked at Charlotte. We're looking at a few markets in Florida, Alabama, and Tennessee. So that's kind of the short version of the story.
Well, give us. Let's do this. I've been doing a little bit of research myself because I'm also in real estate as well. Willie, Marcus, and I also have a real estate investment company. One of them is called the Wim Group. We also do media stuff there. And Willie has a real estate investment company called One Will Properties, and I'm also partnered with him with that company. And we concentrate in the Philadelphia market. But I have heard that there is a lot of opportunity to invest in the southern part of the East Coast. North and South Carolina, Florida, Georgia, Virginia. So there's opportunities there. So Abhi, fill us in a little bit on that.
Yeah, I think there's opportunity in your backyard. You know, when folks ask me, whenever I travel the country and I talk and I keynote and I'm at a panel, the folks will always ask me, where's the best market to invest in? Where do you find the most opportunity? And there are two answers to that. One is kind of a cop-out, which is your backyard. And even though the cop-out, it's really true. You know, I feel there's so many investors or just investors getting started that are willing to go to great lengths to, let's say you're in Philly. I mean, let's say you're looking at opportunities in Dallas. But I guarantee you there's so much more opportunity in Philly than there would be if you were to invest in the South somewhere. It's just the headache, the time, the travel, not knowing the people that you're hiring, not knowing them personally, not being able to get out there as frequently as you could. And that's one of the biggest challenges that even we have looking at Charlotte is that we really want to drive the 3.5 hours there and back to get the same yield, to get the same profit number as we would in Atlanta anyway. So I would say start in your backyard. Now, we can continue talking about that as well. I think the second answer to that, probably a little bit more appropriate, is you look at secondary markets. Now, secondary market is not a primary market. A primary market is, say, Chicago and Atlanta, a Philadelphia, a New York, a Los Angeles, Dallas, some bigger cities, bigger metropolitan areas. That's what you would call a primary market. What's happening now, though, in this world in the real estate markets is inventory is becoming really tight. What I mean by that is it's becoming really difficult to find deals. Homeowners are getting they've been like this for maybe about a year and a half or two. I mean, they're smart. They're smart people, and they're getting smarter and more tuned to where the market is, and they're just asking more for their property. So what happens is we don't really find that many deals because either one, homeowners are asking too much money. Number two, you have too many noobs in the market that are just overpaying for stuff, so we can get into that as well. But yeah, South Carolina is a great option. North Carolina is a great option. Even Georgia, Florida. If you look at Jacksonville, Florida, I think it's the largest city in the United States for rental properties right now. There are a lot of hedge funds and individual investors buying rentals in Jacksonville, Florida, so that's another good market to take a look at. But there's so much opportunity everywhere. I mean, I really definitely recommend starting in your backyard and starting to explore some secondary markets if you can.
Yes, I totally agree with that. The only thing that I'm a little reserved on when it comes to investing, let's say in New York, because the New York market, depending on where you go, but let's say in the immediate 5 boroughs in the city, there's certain areas that are a little pricey. So for me, like if I were to invest in anything right here in New York, I would concentrate more like upstate, or maybe if it's going to be in the boroughs, it would be a market where it's still cost efficient when you're investing. I don't know, what is your opinion on that?
Yeah, I totally agree. I mean, if you look at, say, Brooklyn and the Fort Greene area, I was there maybe 3 or 4 years ago, just visiting, and Fort Greene there wasn't a whole lot. Yeah, there wasn't a whole lot. It was still up and coming. That would have been a really good time to buy. But now, are you kidding me? Like, there's no way. Like, why you wouldn't want to buy in Fort Greene? Very, very similarly, if you're in California, right? There's a reason that your dollar doesn't go. It doesn't go very far in California because the cost of living is really high, affordability is super low, and it just doesn't make any sense. That's where you have investors and hedge funds from New York, California, some of these more expensive cities, San Francisco, Seattle. They're all looking at the Midwest. They're all looking at the Southeast for good opportunities. To give you an example, I'm now, my business partner and I, we're just picking up a small little rental property, nothing crazy, super easy. We're going to buy it for $40,000. We're going to put $20,000 in renovation, and we will rent it for $1,100 a month. So if you take a look at the overall numbers, it's a very solid deal. I mean, we should be netting close to between $300 and $350 a month in positive cash flow. So when you take a small investment like that and compare it to what you might be able to get in New York, you won't. You have to spend so much more money in New York just to get the same return. It's crazy. So yeah, I agree. I mean, I think timing of the market is really important. Understanding your investing mindset and your investment methodology is really important. Otherwise, you're just going to play the game to play the game, and unfortunately, you'll lose. And that's what happens to a lot of people if you're not paying attention.
Yeah, I totally agree. One of the other factors that I look into is being able to physically go to the property. There's an in-between opinion with various investors. Some say, hey, you should go and invest close to the proximity of where you reside, so you'll be able to physically see it and be able to, obviously you can have property managers to manage it, but be able to at least physically go see it, see what's going on before you do anything else. And then there you have other investors that don't mind seeing things blindsided, meaning they would invest in the property, but that property is not close to them. It's maybe a few states away or something like that. So like, what is your take on that? Because for me, I just can't see myself investing in something that I can't physically go, I have to see it. I have to see what's going on. It has to be close to me for me to know what's going on.
Right. I think it all comes down to comfortability. So let me ask you a question.
Mm-hmm.
If you were buying a car,
Mm-hmm.
and you're living in Pennsylvania, and you found the car of your dreams. Okay, it was perfect. It had everything that you're looking for. It had the color. It had the engine. It had everything. It was like super, super awesome and right for you.
Mm-hmm.
But it was located in Arizona. But you're committed to buying the car. You were so excited to buy that car. But let's say you didn't have the time, work kind of kept you super busy. You're always traveling, so you didn't really have the time to go buy the car in Arizona. Would you buy a car sight unseen?
That's a very interesting question. I think that I would make it a point to go there to be able to at least see if it's, the saying it's too good to be true. I have to see it. I have to physically go there, see the car, and once I see it and I see that everything that they're saying is factual, then yes, I'll go and make the purchase.
Totally. So I think there are two categories of people, right? The first category of people is kind of like you and me. Because I want to go touch and feel the car, make sure it's like a real car and not just like a cardboard car that somebody's just selling as a lemon on Craigslist, right? That's really important. But I want to be able to see it, touch it, feel it, drive it, check it, make sure that it goes to a local shop and check for damages, anything that needs to be corrected, repaired, all that. That's just the kind of person that I am. So you and I are very similar in that regard. There's somebody else, the second category person, would totally be okay with, you know what? It's a car. What's going to happen? I have the VIN number. I have a clear title. I'm going to do the entire research on that. I'm going to get my Carfax. Okay. And then I will pay for an inspector to do a 150-point inspection. They'll email me or they'll text me the copy of the report. Okay. And then I'll just pay for shipping and then make sure that it's titled in my home state. So essentially what happens is you have two kinds of people again. One, that kind of investor that's going to go and check out the property in person.
Mm-hmm.
And the type of investor, the second type of investor would be the investor that has no problem just saying, hey, you know what, it makes sense, and I have people for that. I think it really depends on how comfortable you are with making those types of decisions. Personally, I'm not buying stuff sight unseen. I'm going to go, I'm going to check it out, because with real estate, granted I'm making an analogy between real estate and cars, but real estate is very, very, very involved. And it can be super tricky, super, super tricky. It could be the way that the land sits on the road. It could be a titling issue. It could be a sewer issue. Who knows? So going out to the property and checking it out is really important. And that's only on the single family side. Imagine if you're buying a 100-unit apartment complex. Would you really buy that without checking it out? Probably not. And a lot of pro investors would tell you, you know what are you doing? You must be out of your mind. Don't do that. And they're right. You need to put hands on the property if you know that it's something that you want to buy. So it's just a common mistake that I see new investors make, and even seasoned investors make too. They're like, I have so many deals in the pipeline right now. I can't possibly go see them all. Well, you know what? Fine. Then go see the ones that you absolutely know you're going to buy, and then scrap the rest. Because the last thing that you need is to make a mistake with your own money and other people's money, and that's just not a good look. It's just not a smart decision-making. Decision-making is just not smart at all.
Yeah, no, point taken. I feel the same way. And, unfortunately, because Willie is not here, but in the past, he's spoken of his experiences. He had one deal. This is when he first started out a couple of years back. He was doing a joint venture with another person, and they were looking in the Cleveland, Ohio market. And they had one property under contract, and I don't know what happened across in time that they found out that the house had a lot of damage. The wall, I think, collapsed, and there was some just like other issues that transpired, and he had to basically walk away from that deal. He lost some money, but it wasn't much. And he said, this is the last time that I go and put something in an investment and I'm not physically there. So now he, when we're working with people, and especially in the Philadelphia market, I'm a real estate agent and I do look into the Philadelphia market, but we also work with another agent or broker per se. She has a firm and she's very investor friendly. So we make it a point to go and travel there to take a look at the properties, because it's like, it's you don't know what you're walking into. And I get a little leery when, the property is there, you want to take a look at it, you want to see what's going on the inside, and, so you can make a determination of how bad it is so that you can do the repairs and so forth. And you can't physically go in. You have all this red tape and all of that. I get leery. And I don't see how and I guess you're right in a sense that, you have to be it depends on how comfortable you are, but I just can't see how you can go forth on something like that,
Yeah, if you're a individual investor, there's no way that you're totally setting yourself up for failure. But quite frankly, if you're a hedge fund and you have, say, $20 million a year that you need to spend, will it really matter? Right? So there are folks that will use that as an excuse to say, well, you know what, it's okay. It's not okay. Are you kidding me? It's not okay to be ignorant of what you're buying. Sorry. And then you're not, if you buy something and you don't do the right due diligence, then you have absolutely no right to complain if the investment just turns out to be bad. You have to do all your due diligence up front. There are folks right now where they're coming out of these classes, they're coming out of the education seminars and the guru seminars, spending $20,000, $40,000, $50,000, and it's obnoxious sometimes. I think Lauren and I did a podcast on Real Estate Deal Talk, and she mentioned one of her friends. She's the co-host of my podcast. One of her friends just finished paying like $70,000 for real estate education. And then they wanted to go start buying real estate immediately. They had all the buying criteria, but they're making the simplest of mistakes in making offers. Your acquisition price plus your renovation price must be, in every single scenario, less than or equal to 70% of your after repair value. If that equation is not followed, I do not care who you are. You are putting yourself at risk to any type of market change and condition. And it's happening right now. It's happening right now, even in Atlanta, even in the apartment complex space. There's so many apartments that go around, and the apartment complexes themselves are having trouble filling all of them, so they're offering some concessions, et cetera, et cetera. Well, everything has a cycle, even in the single-family space. If you're not buying right, and you catch yourself on, say, on a plateau, and that plateau, and it corrects, say, 5 or maybe 10%, I don't think we'll have a crash like we did in 2007 and 2008. Mm-hmm. But even if it corrects just a little bit, mm-hmm. and you can't sell, boy, oh boy, oh boy, I mean, you're putting yourself into a pretty bad financial situation just because somebody else told you so. So having a real estate agent on your team is really important. Having good wholesalers that bring you good properties that makes sense, that's important. Having a good inspector on your team, that's really important. And we talk about that as well all the time on the show, just as much as you do, I'm sure. But having that team is so crucial, because for me, I'm your capital guy. I'm the guy that's going to go out and find the money to make the deals work. But if you meet me in person, I'm 5'5" and 120 pounds. Like, I'm not going to lift a hammer. Like, I know what a sledgehammer looks like. I'm sure as heck not going to pick one up. That's not my thing. I don't understand. Dumbbell curls. I don't work out. I just don't pick up that kind of stuff. But I have great contractors that work with me, and we work together as a team so that we can see each deal to completion. And more importantly, we won't buy anything unless we know unequivocally, we can put ourselves in the best position to make money on it. And you have to go into this thing with that mindset. Otherwise, like, mindset is everything. Otherwise, you're just screwed. You know what I mean?
No, I totally get it. Listen, Willie and I are always talking about that on the show. There's a few factors that are going on right now, as from the time that we started this partnership. We are seeing a lot of new quote unquote investors, either if they're doing wholesale or if they're doing buy and hold and so forth, and they have no clue as to what is going on with the market, what you have to look for, and all of that. And then they go and they try to approach these deals to other investors that are more savvy. They're more seasoned. They've been doing this for quite some time, and it's just becomes chaotic. It's just very chaotic. It's like they recycle some of the information that they obtain, and it just becomes this ongoing chaotic situation. And then in regards to what you were saying about the team, we also agree on that. We can't physically be everything. You have to have someone an individual that is in the legal aspect. You have to have a real estate agent or broker, because they're familiar with the market. They would understand what your requirements are, and they can bring that to you. You have to have a contractor or anybody in that realm, because you're not going to be doing the physical work. You're basically delegating it out to other people. You have the money there to be able to expand that out to your team, and that's the important factor in all of that. And so we totally agree on that. It's just, I've heard some complete horror stories, and every day I hear horror stories from various people.
Yeah, real estate is a team sport. You have to learn how to play nice. You have to learn how to give and take. You have to put smarter people around you so that everybody can function appropriately. My entire team is significantly smarter than I am. Like, I have no shame in saying that. When it comes to capital raising, I think I got it pretty well. But I think I can work my magic with that. But when it comes to contracting, you know what? Mark, he understands. When it comes to operations, Walt, he gets it. When it comes to expediting permits at the city, Tiara, she has that. She has that so on lock. It's unbelievable, and it saves us so many trips to City Hall. It's ridiculous. But we need these kind of people. Otherwise, we'll just flail about. And like you said, to your point, Michelle, we have so many new investors coming in to play the game, which is great. I encourage everybody to play the game, but play the game being smart about things. Build your team first. Don't just jump in just to jump in because you have a little bit of money to spend, or just because you want to buy a house to flip. Don't give in to the fallacy of HGTV and what it presents real estate investors and what it presents the world to really be. Because you can't just flip a house doing a commercial and make money on it. Mm-hmm. And unfortunately, that's what we're seeing these days, is the expectation. Right, the expectation of a flip is that, I should be able to buy, renovate, resell, and the entire process should take less than 30 days. For some, it might, but those few are really pros, and they understand. They have all their design elements down. They've picked out all their colors. They know all the SKU numbers from working with Home Depot or Lowe's or their favorite supplier in the past. They understand that, so they can do a flip inside 30 days. But for the normal person, if you have a budget of say $15,000 or $20,000 on a renovation, your burn rate on the budget is probably going to be about maybe $2,000 a week, maybe. So if you're spending $2,000 a week for a $20,000 budget, you'll be in and out in 10 weeks just to finish the rehab. Then you list it, depending on days on market in your area. Let's say it takes 15 days to sell, plus another 30 days to close with the buyer's financing. That's like a 4 or 5 month project for most people. Mm. So let's not buy into this dream world that we're being sold on TV about how flipping or buying real estate or renting real estate, how that's presented. Because it's not that at all. It is a very non-sexy business. Even though I feel like people want it to be sexy, it's so not sexy, you know? So I think it's kind of funny. I don't know what your perspective about that is.
Listen, listen, Abhi, I totally agree. This is my take on it. And like I said before, Willie and I always talk about it. We have other guests that come on that are also in real estate. And we ask that question because we like to get their perspective, their opinion on it. And what really kills me is that they don't understand the time, energy, and effort that you have to put in, the money that you have to put in. And sometimes it takes, for some people, years before they can really perfect down to the wire the deals. And sometimes even when they have deals, sometimes the deals don't go accordingly and they have to kind of like walk away from it and all of that. But it does take a lot of time to really get learn the craft and get the skill sets to really make that determination of deciphering which deal is a good deal and which one is not. Sometimes we do hiccup every once in a while, we're all human, but I just don't see how the new investors, they want to go in because they saw the whole glamour on DIY, GTV and all of that, but they don't understand that those people that do have the show, they probably had a few years of going out and just repeatedly doing the same thing over and over again and building a reputation in order for them to be on TV. And, and it's not just them. It's like, even with the real estate, like the $1 Million Listing, I love these shows, but they cut out that extra part of the things that go on in between. Sometimes those deals don't go accordingly. Sometimes like you go forward with it and then something happens in the back end. Not everything is going to magically resolve itself. And that's the part that they don't seem to understand, that when you're going into something, you have to dedicate 100%, and you need to understand that there might be certain things that might not go according to what your plan was when you first went into it. And
that's a really good point. That is such a good point. We have an idea of timeline. We have an idea of budget. We have an idea of what should happen, when it should happen, who's doing it, how much it's going to cost, and the expected result, and the expected outcome. Like, how is it going to look after all of it's done? But you know what? It doesn't happen like that all the time. Like if you're tearing down a house and you are installing footings, you're putting in footings, you're pouring concrete. Let's say it rains really badly. Well, you know what? You can't pour concrete if your trenches, if your footings are completely covered in mud, and if there's mud that's slid in there, you have to clean all of that out. You have to let it set. So you have to let the ground dry. And then you have to pour concrete back in. And I'll tell you, I mean, in Atlanta, we can get rain. And if it rains and we're just in the initial construction phases, we're just pouring concrete into the ground to set the base of the structure of the home. But before we do that, let's say it rains a whole lot, that can knock us off our timetable anywhere between a week, 2 to 2.5 weeks, just because we have to let the ground dry before we pour that concrete in. You know what? Can we control the rain? Nope, we can't. So you're absolutely right. My buddy Andy Williams, he's on Flipping Dallas or Flipping Texas, and these shows bring on pros. Like, they bring on folks that have been there, that have done that. They already have the teams in place, and they get the game. So their objective is to speed up the process, to give you a glimpse of what the life looks like with a little bit of drama. But don't take that as what real life really is, because the chances of you being a new investor and having all of these things already set in place, like my buddy Andy, if you already have your funnels bringing in deals, how do you create those funnels? How do you sort through those deals? Who's doing that? Are you doing that all the time? How is all that lead gen happening? How are you evaluating your deals? When you go out there, who's on your team to be out there with you? How's your capital structured? Where are you getting your money to make these deals happen? And then who's executing with you and who's holding these timelines accountable? Is it a project manager? Is it a licensed GC? Is it a combination of both? Do you have all these multiple people on your team? The likelihood of that happening when you're just starting out, it's just not there. And unfortunately for a lot of people, then you end up in this state of overwhelm. Right? It's like, oh my gosh, I just went through this course. Oh my gosh, Friday, Saturday, Sunday, I was in an all-day course for 14 hours a day, $20,000 later. My brain is jam-packed with information. Now I have to execute. And you know what to execute on first? Let's find a logo for our website, for our company. Let's pay attention to the bigger things here. I understand you're in a state of overwhelm, but finding a logo and starting small and starting there is not the answer. Right? Let's really get out there, shake some hands, and do what we have to do to find the right people. Because if you're new, you need a mentor. You need somebody that's been there, that's done that, just like my buddy Andy, or like you guys, Michelle, or for folks that have questions about the stuff, get in touch with me too. But you have to find somebody that's been there, that's done that understands your local market. Otherwise, they'll be just as clueless as you are when executing these deals. Have you ever had that happen for any of your clients or any new investors that you know in Philly?
Yeah, we get that all the time. In fact, we were working on a joint venture. This is about a year ago. We were working with someone that does wholesale, and we went down to Philly. There were a couple of properties that Willie was interested in, so we went down there. We took a look, and it wasn't. One of them wasn't even available. I don't know how that happened. And then in conversation, she told us that that was from her father. I think she works with her father or something like that. And she wasn't told that property was no longer available. Then we looked at another property, and that property, it wasn't bad, but it didn't fall within the guidelines of what we were looking for. So we basically had to walk away from that. And we get that all the time. It's like I said before, there are situations where they don't know what the particular investor is looking for. They just send out whatever, but they don't pay attention to what the requirements are. Or even if you are an investor, you have the money and you want to go out and find a deal to invest in, you have to do your due diligence. You have to do your research. You have to make sure that, you're going to be receiving money in the back end after everything is completed. And they don't seem to get that. I even had one experience where, and actually it was Willie that had this experience, where there was one person that was had a wholesale deal, and they were looking at property. He was like, okay, so tell me what the ARV is, tell me what this, tell me that. And the person was basically quoting something from, I think it was from Zillow, instead of really doing the research and coming back with factual information. Nothing against Zillow. It's just that if you're doing this, the whole intention of you investing is you're investing at a discount. You're not doing this at full price as if you were doing a traditional market. And that was one of the things that he just told me. He's like, I don't understand these people. I can't comprehend where they're getting it from, but they think it's so easy because they see a couple of videos here and there. They automatically think that they're part of the investment game. And my whole take on that is that if you're going to go into something as significant as in real estate, you have to partner with mentors. You have to partner with someone that has been doing this for quite some time. They have a good track record, and they would be able to help you along the way.
You need that. You absolutely need that support. And like you said, doing due diligence is of utmost importance. And the biggest problem that I see is that those numbers they're just not right anymore. And why are folks buying at greater? Why are they violating the 70% rule, right? We alluded to it earlier. I think I said it earlier. I think it's worth talking about again, it's a simple addition and division. Okay, so if you want to pull out your calculator and walk with me, great. So let's say you're buying a property at $50,000. And you're going to put $20,000 in renovation in it. So 50 plus 20 is $70,000. You're going to take $70,000 and divide that by the ARV, the after repair value of that property. Now, the ARV number, that's very, very unique to calculate because not everybody gets it right all the time. And there's a little bit of a vision that's required to find it as well. So we'll probably go into comps in a little bit in a second. But let's say that you figured out what the ARV is, and the ARV is $100,000. Okay, so you're going to go $70,000 divided by $100,000. That is 70%. Okay, that 70% is the rule. So never, ever, ever do you want to deviate from that. Okay, all of your acquisition plus renovation numbers should come in less than or equal to 70% of ARV. And that's, in this case, $70,000. You shouldn't be paying more. Your total project cost shouldn't be greater than 70% of after repair value. Now, how do you work backwards? Well, if you know what the ARV is going to be, well, then the question is, how much should I offer somebody for this property? Well, super easy. Let's take that exact formula and work backwards. Let's say you already know, because you're awesome and you're listening to this podcast and you're paying attention to the real estate world, that your ARV, your after repair value, is $100,000. Immediately you're going to do 70% of $100,000, which is $70,000. And let's say that you took a general contractor out there who's licensed, that you can trust, that you're referred to, and this person gave you an estimate to repair the property for $30,000. Okay, so $30,000 is your renovation budget. So 70% of $100,000 is $70,000. Subtract from that $30,000, which gives you your maximum allowable purchase price. You cannot pay anything more than $40,000. There are way too many people that are violating that rule. And let's say that you go to the steps every month during the auctions, and you know what? You're excited. You get super, super hyped because that property that you saw, you want to buy. Well, you know what? Sorry, folks, this is not eBay. Even though eBay is an auction house. You are not allowed to do what you do on eBay for your favorite baseball card. You cannot do that on real estate. Once it violates your rules, you stop. You cannot and should not buy, period. But that's what's happening right now. You know, I think this was in February or March. There were 400 people at the Fulton County auctions, the courthouse steps, for that Super Tuesday. There were so many mistakes made that day. It was unbelievable. It was crazy. And I'm friends with a lot of lenders here in town, and you know, I got calls, and they're like, "Are you kidding me? Who's buying this stuff? It doesn't make any sense." So when we have too much overconfidence in the market, and when people are too happy about real estate investing, and there are too many new people, here's the balance, right? The balance is, I want there to be new people investing in real estate because I think it's a great way to leverage and diversify and make money, or at least invest your money. But at the same time, I'm keeping an eye on how many new people are really getting into the game, because that will tell me how I should move accordingly. If there's so many new people in the game, then you know what? Maybe, just maybe, it could be an indicator that the real estate market might be coming to a plateau. It might just stop rising as fast as it once was. So take a look at that as an indicator. Affordability is another indicator. You know, as the Fed increases interest rates, affordability of homes decreases. So for every quarter point that, I think Keller Williams put out this statistic, and I'll have to reconfirm that. Maybe we can put that in the show notes. But I think Keller Williams said for every quarter point of interest increase, I think the overall affordability for the average American decreases by like $10 or $15 or $20,000. So what does that mean? That means if there's or in my world, or the way that I would think about it, is if there are too many new real estate investors in the game, and if the overall thoughts of real estate investing is, oh my gosh, buy real estate, buy real estate, buy real estate. If you jump in an Uber in Philadelphia and you're like, holy cow, this Uber driver is a real estate agent, and you keep doing that, and you keep seeing Uber drivers that are interested in real estate or that are becoming agents. What do they say about taxi drivers in New York and the stock market? It's like if there are too many of them talking about the stock market, then it's probably a good time to get out of the stock market. Yeah. So that's what I've been doing in Atlanta, a little social experiment. And soon enough, I found out that there were a lot of drivers, Uber drivers. Again, nothing against those drivers and nothing against Uber. Quite frankly, I use Uber every day. But it's just a small little indicator of where I feel the market is and where I need to take my strategy. So just something to be aware of. Are you finding that in Philly where you are? Are you finding like there's a lot of optimism about the market right now?
Yeah, we are. And as a matter of fact, Willie we were just having a conversation a while ago that he wants to, he still wants to concentrate in Philly and certain parts of Philly, but he wants to also concentrate in Pittsburgh. That's his next market that he wants to look into. We're getting positive feedback, but the thing is that now it's starting to be like Brooklyn in a sense where there's certain areas in Philly that is just too concentrated and everybody wants to get into it. And like you said, there's nothing wrong with that. And I encourage it as well, but it's becoming saturated in a sense where it's just too much people in that particular market. So you have to kind of migrate a little bit outside of that and go find another area that would be suitable.
No, and I agree. I think that's why you take a look at these hedge funds in New York and wherever they might be. They're looking at secondary markets. They're looking for those smaller cities outside of the major big cities that may be prime for investment. That's where the growth is going. And I agree with you. I think that we're still in a growth phase. And we're starting to see a little bit like when it's difficult for me to win the game in real estate, then that's when I know that there's a shift that's coming. Absolutely. Like, I know my numbers are right. I know what it's going to cost me. I know what the true value of property should be in this area. But when those things are being violated, that's a complete red flag for me. And when I can't win, then I know the market is going to change. Because the moment that I put an offer in at 68% of fair market value or of ARV or 70% of ARV and I'm constantly being outbid, it's time to change my investment strategy. And now you might have the naysayers and you might have the folks that say, oh, it's just going to continue to go up. And, why would you do that? Because you have to spend more because the real estate market will be, say, up by 30% next year. Or by this time next year, it will have increased by 30%. To which I say, can you guarantee that to me? Can you guarantee, put down on a piece of paper, that this real estate market, as you see it right now in, say, Kirkwood, Atlanta, will increase by 30% this time next year? Put that on paper, sign it, and then, give me like your left leg as collateral. But they won't. So we're all basing this on speculation. We're all basing this because we go to the shopping mall, look at Jimmy Choo's if you're a lady, or Armani if you're a guy, and you buy that suit knowing that, oh my gosh, this feels so good to spend money on this suit or on these shoes, and I'm going to do it again and again and again and again. And then over time, you get so used to buying good stuff that you actually feel really good about your purchases, even though your purchases may not be the best, or you may have overpaid for them. So just to give you a little bit of an example, that's what's happening in the real estate world. right? What's happening is those numbers are starting to increase at an exponentially increasing rate, which over time is very unsustainable. So where does that leave us? That leaves us questioning what we are doing in the market and questioning our investment strategy, which is a really good thing. We have to do a mindset and level set on that. We have to understand that our mindset, we have to level set our expectations and maybe realign our strategy a little to see what really makes sense. And here's what I'm doing right now. I'm spending 40, and this actually came from one of my buddies, Rick, over at his campus in Orlando. He gave me this really good idea. I think it was maybe last year and a half. He said, you know what? 40% of your activity should be in the flip world, because it makes sense. If you find the occasional deal, buy it. 40% of your activity should be in cash flowing assets. Cash flowing assets would be a single family house that you rent out, or a duplex, or a tri, or a quad, or a larger apartment complex if you can buy that. That's the other 40%. That leaves us with 20%. So you got 40% on flipping, 40% for rentals, 20% for, let's call that your riskier investment that you have control over, that you'll probably see some really good gains on. For me, that would be investing in a small business that's already seeing some good cash flow, good returns, good EBITDA numbers year after year. For somebody else, it could be creating and starting that small little business or starting that startup. Like that. I've been paying attention to these couple of brands that have just launched on Instagram, and they've done well. And maybe starting something like that with $10 or $15 or $20,000, but that should only be 20% of your overall activity. So we are diversified within the real estate investment activity that we're doing, and we're also paying attention to the numbers. So now you minimize that ability. Well, you minimize the opportunity for failure. You minimize that risk that you're taking, and you're increasing the amount of times you can win, not only with the deal flow, but then also the profitability of each deal will start to go up, because you'll be able to sleep at night knowing that you didn't overpay for your house or for your deal or for your duplex or for your tri. Because you know what? I cannot handle that many phone calls with all you people making those mistakes, and then I have to sit here and help you sort it out. I just can't do it anymore. It's just buy right.
No, and I totally agree with that. And I like that. I like the ratio. Your friend and partner has a valid point. And you know what? That's kind of like the same thing that Willie and I have discussed, and even with Marcus. Marcus works with hedge funds, and they the companies that he works with, they invest in various things. There are a few companies that invest in real estate, so they're always looking at outside markets. They don't look in New York, because New York it's too saturated for them, so they rather just go out of state. They're looking at North and South Carolina. They're looking at they're looking in Pennsylvania. Not exactly in the Philadelphia market, but in other areas. And we've had this conversation a while ago, and we were trying to determine how much are we going to go into investing, how much are we going to meaning to hold a property, or the percentage of fixing and flipping it, how much in a side business, because Willie is one that he likes to, his dream is really to have a side business, just so that he has extra cash flow coming in. And, we were just trying to make a determination, like what is the percentage? And, now that I hear you saying it, I'll reiterate it to Willie, so that he gets it as well. I think that's a good ratio. I really do. And it's good to have a smaller percentage on, on more riskier things that you want to do, because now you're not holding a bigger percentage there, and then you start losing out money. If by chance something happens that you lose something, it's not astronomical. So I really do like that. I like that ratio.
Yeah, no, that's absolutely right. And I think the biggest thing that we can do for ourselves as real estate investors is make sure that we're diversified within real estate,
Mm-hmm.
and we're also looking at opportunities outside of real estate that can provide some type of return and income. It's not enough anymore to only have one asset class as a primary source of income for investors. It's not good enough. It's just not. So we have to be more versatile. It is up to us. We write our own financial futures with the skill set that we have. And if we don't pay attention to that, and if we don't get better, we'll lose. It's that simple, right? If the market corrects next year, or say, maybe not next year, let's give it another 24 months. So in 2 years, let's say the market corrects by 10 or 15%. And let's say that you're a wholesaler and buyers aren't buying. Let's say you're a flipper and buyers aren't buying. Your retail homeowners aren't buying because affordability is decreased, and now they're all renting. Did you take heed of this podcast? Did you take heed of what we're saying and buy rentals? Maybe you did, maybe you didn't. But if you did, think about that in the future, and you would have saved yourself a lot of headache, right? You would probably be sitting on a very good pile of monthly cash flow. Now, I noticed I was kind of perusing through some of the guests that you've had and on your show, on your podcast previously, Michelle, and Angelo Remora from Ohio Cash Flow. He was one of your guests, and he's a really, really good friend of mine. I love him to death, and he is the king of cash flow. So, talk to him about residential single family. I mean, I'm buying residential single family rentals all day right now. Especially that example that I gave y'all initially toward the beginning of the show was that a 40 buy, 20 renovate, and then rent for $1,100 a month. Heck yeah. You need as many of those as you can. And then understand how businesses work. Don't become complacent. Don't get lazy, because lazy people lose, right? The guy or the gal sitting on the couch eating cheese balls, watching TV will lose. Like, I have Netflix, but I watch maybe 30 minutes of TV a week. I have no time for this stuff. There's so many relationships to be had. Awesome people like you and Willie that are putting out really good information, paying attention to you guys, figuring out what's happening, being on the cutting edge, getting involved, getting into deals, raising capital, finding the right deals. You have to hustle right now. And then start investing in businesses. Start investing in yourself. If you don't have that ability to invest in businesses yet, great, no problem. Invest in yourself, invest in education, and get it done. Because it's no longer an excuse. Financial failure is no longer an excuse unless you have amnesia and have completely forgotten about 2006 and 2007 and 2008. If you're born, the only people that I will give a pass to is newborns and children under the age of 5 or 6 or 7. After that, you have enough capability to know what to do on your own. So get the education, make it happen. And if you're a kid listening to this and you're like 10, and I hope you're listening to this, get mom and dad involved and say, hey, I want to learn how to invest. And then push them to really, really, really take heed of that. Because it's not only their financial futures at stake, it's also yours.
No, I totally agree with that. I think that the younger the person is that you can teach them about real estate and real estate investing and partaking in it, the easier it would be for them as they get older, because now that it's implemented in them and they can go out and be able to be more productive. And that's, I didn't get that opportunity until I was in my late 20s, early 30s, in regards to venturing out, having my own business and, being an entrepreneur. And I come from family that are entrepreneurs. Ironically, it skipped a generation. My parents weren't into it, and I got the bug, and I just went with it. And I, at some point in time, if I have kids, I would, instill that in them as well, because there's so much opportunity out there. You don't have to put yourself in a box and, go on to the day to day. There's so much you can do out there, be productive, and being able to have your own business is, I don't know, it's an accomplishing, it feels great to have that. I don't know, what your take is on that.
Yeah, I think it's an incredible feeling of accomplishment, and more importantly, it gives you the freedom and the power over your time. There are folks that say time is money, and I wholeheartedly disagree with that, because that is such an insult to time. It's unbelievable. It is unbelievable. So time isn't money. Time isn't a tool. Time is real. Money is real, but money is more of a tool than time is. But how much would you give? How much money would you give to just spend an extra 10 minutes with your kids, or to spend an extra 10 minutes with a loved one, or an extra 10 minutes doing something that you're passionate about, or giving towards something that you're passionate about?
No, and you're absolutely...
Does money buy that?
No, and you're 100%, that's right on point. I think that priorities is one of the main factors for individuals, when it comes to time. The time that you invest in doing other things like watching TV or doing some other stuff, you can be more productive trying to run a business, and then have that extra time to be able to spend it with your family. And I think that that's more than anything for me. Like, that would be my why. And has been my why when I started to get into this journey of having my business. Abhi, we're going to be wrapping up in the next couple of minutes. So I wanted to get our listeners out there. Where can they find you?
Great question, and I love that. I love what you hit on, just taking it right home to why. If we don't have that super clear, we will not. There's no way that we can play the game. So if you want to find me online, the best way to do it is to go to realestatedealtalk.com. That's where I live. I'm on Instagram. It's the same thing, realestatedealtalk.com, Snapchat, YouTube, all that stuff. I'm on the radio every single day, Monday through Friday, on a very local channel here in Atlanta called Biz 1190. And so you'll go to biz1190.com, click listen live every day at 3 p.m. Also have a daily podcast from Monday through Friday that we put out, also called Real Estate Deal Talk. But if you want all this information in just one page, go to realestatedealtalk.com.
Awesome. So guys, if you want to find us, you can find us on iTunes, Stitcher, and YouTube. That would be the Work Your Money podcast. And also you can find us on Facebook, Instagram, and Twitter. Same thing, Work Your Money podcast. And guys, I am very, very happy. It was very interesting hearing your perspective on everything, Abhi. Thank you so much for being on the show. And guys,
you're very welcome.
And you're always happy to, I'm always welcome to have you back on the show. I'd love to have you back on. Maybe the next time we can have Angelo on. That would be a very interesting conversation. So guys, until the next time, this is the Work Your Money podcast. Good night. Bye.